Welcome to the AACFB's 2024 Meet the Funder webinar series. My name is Monica Harper. I'm the Executive Director of the AACFB, and I will be your host. Our presenters today are Stephen Engel and Alicia Kramer from Channel. Channel is both a funding source member and a gold sponsor of the AACFB, and I'd like to thank them for their support of the association. Before I introduce Alicia and Stephen, I'd like to go over a few items to make this webinar more enjoyable and informative for everyone. During the presentation, you should see a Q&A box that allows you to ask questions. If you have any questions during the presentation, please submit your questions in the box and they should be answered by the end of the webinar. If you prefer to ask your question verbally, you can raise your hand and you can be unmuted to speak. Please reserve the chat box for communication between attendees. The entire webinar should take no more than 30 to 45 minutes. And for those of you who would like to review it at a later date, it will be posted on the 2024 Meet the Funder page of the website, and it will be emailed out to the AACFB membership. At this time, I'll turn it over to Alicia and Stephen. It is all yours.
Excellent. Thanks, Monica. Thanks to the AACFB as well to allow us the opportunity to share a little bit about Channel and the things that have been going on in our world. So I'm Alicia Kramer. We'll start there. I am the Senior Vice President of Sales for the Western part of the United States for both our equipment finance and our working capital product. I've been in the industry for way longer than I care to admit, but the primary responsibilities that I've had in the past have been developing both manufacturer and vendor relationships in the office equipment space, as well as the automotive aftermarket space. Today, I'm responsible for leading the sales team in the Western half of the United States for Channel. Stephen, your turn.
My name is Stephen Engel. I represent the Southeast part of the country for Channel, and I've been with Channel. This is my 7th year, and my background is more specifically in the manufacturing and construction space. A little bit about who Channel is for those of you who don't know. We are an on-balance sheet funding source offering equipment finance and unsecured working capital. Established in 2009, we started the business under the premise that there are companies, many companies out there that need equipment, but there are also companies or small businesses out there that need working capital, but nobody was taking advantage of doing both. So we started the business under the premise that we could offer people working capital to those same equipment funding companies. We're a nationwide portfolio lender, fund in all 50 states. We have over 200 employees. We're based out of Minnetonka, Minnesota. And to this date, we've funded a little over $2.3 billion in small ticket transactions to over $25,000 or over 25,000 businesses. This is a little bit about how we kind of view ourselves and how we identify versus other folks in the industry. And the first thing we always say is we want to deliver a non-disruptive approach to the industry, meaning we understand that you have a business and Channel's not your only funding source. You have a bunch of different places you can take someone. Our job is simply to be the money in the background. Specifically, we do that by understanding and connecting with people's businesses. We don't want to be a black and white credit box. What we want to do is understand our customers' businesses and align specific products that deliver solutions for that business. We understand we're not a bank. So for us, it's not necessarily a race to the bottom line, but truly, we believe we take the time to understand our partners and how they approach the world and understand that each and every one of those partners is a little bit different. And our job is to simply connect products that solution for our partners. Single source is something I kind of just touched on a little bit ago. But again, when we started the business, we thought about, we knew the leasing side of the space very well. And we understood that small businesses need equipment. But we also understood that they needed working capital. And not only do small businesses need both products, but you could actually leverage both products together to kind of be as a benefit, to our partners. Tech and data enabled. Now, we don't think about this like we don't consider ourselves a fintech company. We'd never consider ourselves like a lending tree or an online platform. The way we think about tech and data is we use technology to make our partners' lives easier? How do we make deals flow really fast? How do we decision deals in hours and not days? So again, by no means a fintech company, but we do consider ourselves maybe on the leading edge of how do we think about technology and how do we help then translate that into making our partners' lives easier, and then win together. At the end of the day, if we're not producing win-win-win scenarios for ourselves, for our partners and our customers, if there's a disconnect somewhere, well, those customers aren't going to come back, and we live and die on repeat business. So we understand that there are times where we might need to go shoulder to shoulder. Maybe it's to win a vendor relationship, maybe it's to win a long-term borrower, but we know there are times where if you're not winning, we're not winning. So we believe that's one of our core beliefs, that everybody needs to win, and we strive hard to do so.
Excellent. Thanks, Stephen. Well, before we jump into some more of the details of both of the equipment finance offerings as well as the working capital products, I just want to clarify to the industry that Channel is still funding equipment finance business, and we are still funding working capital business. That's changed a little bit since the spring. We made the decision in early spring to slow down the equipment finance business, and we did that for a couple of reasons. We saw some macroeconomic conditions feeling a little bit uncertain, but more importantly, we saw a big influx of business based on some of the other things that were going on with other industry players, as well as some stress in the tier 4 and tier 5 credits that we had put on the portfolio. Final piece of the decision was just the fact that we had some systems and processes that needed improvement, and they were not best in class because we scaled really quickly, and probably more quickly than we had anticipated. And so for all of those reasons, we made the decision to slow down our equipment finance business. I'm excited to say, though, that we are on pace to fund about $200 million in equipment finance this year, and we anticipate opening things up a little bit more as we head towards the fourth quarter as well as 2025. So with that said, let's talk a little bit about our equipment finance product as it exists today. It is different than what it's been in the past, and we anticipate it evolving as we open up. But for right now, we continue to be a risk-based price and credit company. We finance all different types of equipment. Our credit philosophy is that we look harder at the credit than we do at the asset, but we do take the asset into account when we do our underwriting. Average ticket is going to be anywhere from $15,000 to $200,000. Right now, I would say that we're really strong in under $75,000, and that's kind of where we're looking to play right now during this window of time. And like Stephen said, our whole philosophy is to be non-disruptive so that we can win together. And so we enjoy learning about all the opportunities that you have in your business and how you're planning to grow and what we can do to be a part of that if there is a place for us. One of the ways that we do that is we connect our partners with their underwriters. They have a handful of underwriters that are dedicated to them and a couple of funders as well. And so we really feel like the more intimate we can become with our partners at all levels of their business, not just sales, not just underwriting, not just funding, but even down to the collections level as well. We really feel like those are the types of partnerships that are going to flourish in the long term, and those are the types that we desire to have together. With all of that said, and understanding that most of the folks on this call are focused on equipment finance and don't have a ton of experience with working capital, Channel's been really thoughtful about trying to help those equipment finance companies kind of dip their toe into working capital and to change the conversation with their borrowers so that they can introduce working capital to see if there is a need. And so one of the ways that we've done that is to look at our equipment finance approvals. And if it qualifies, we will automatically offer a small working capital approval along with that. No additional information needed, but really the goal is to allow our partner, our equipment finance partner, to go back to their borrower and ask more questions. What are they getting the equipment for? Is it replacement or is it new? And are there ways that they might be able to utilize a small amount of working capital in order to springboard the whatever growth initiatives that they have? that are spurring the need for that equipment. So let's talk a little bit more about working capital. So statistically, 56% of all businesses use working capital to grow their business. For those of you that collect bank statements on some or all of your deals, I'd encourage you to take a peek, take a look and see if you've got customers with weekly withdrawals from some real common names out there in the industry. If you see those, that's an indication that those customers, your customers, are using working capital. And so it's an opportunity, again, to change the conversation and to ask more questions of those borrowers. We do working capital loans or advances up to $250,000. And really, this product is very different than an equipment finance deal. It moves really quickly. Typically, if we've got a customer that's interested in working capital, they've got a time-sensitive need that doesn't allow them the luxury of going to their bank or looking for other opportunities for capital. And so that's where we and our partners like to come in and help them fill that need in order to help them leverage the opportunity. Payments can be done on a weekly and a monthly basis. Monthly is a little bit more of a differentiator for channel. And we also offer custom programs as part of our working capital program as well.
So we're going to get into a little bit of maybe the basics of working capital. The first thing, and maybe again, a differentiator of channel, is we don't really view the customers that you send in that are looking for funding as our customers. We always view those as your customers. Matter of fact, on average, when we do a deal, that borrower will average 2.5 to 3 deals with, and a large part of that is our renewal team. That's designed to dig up funds and constantly act as almost an extension of your sales team on your behalf. And anytime they ask about equipment, those always get kicked back to the originating partner. But we would try to continuously renew that customer to get them more money, and you would subsequently get paid on that customer. But just as a minimum, so an app package is an app that's your application and 3 months of bank statements from the business operating account. And then as a minimum, we're looking for a 625 FICO, 2 years time in business. We can go down to 1. Those deals can get a little bit tougher with that short, and annual revenues of 150,000 or greater. And then the smallest deal we could do is about $5,000. So that would make anything north of those 4 categories would make sense for us. But on average, these are actually pretty good customers. We always say, a lot of people think of working capital as this is desperation money, or this is someone ran out of money and they just don't have anything left, so they need an option. That's not really what this is for. And statistically, our average customer has a 711 FICO, 11 years time in business, 1.8 million in revenues, and we usually average about 70,000 for a ticket size for that transaction. Well, if you look at that profile, that's I don't want to say it's bankable right now, but that's a good customer. You know, most people on this call has 4 or 5 places they could place an equipment deal with those credit attributes, but that's just our average customer. And then, you know, doing working capital, right? You're gonna drive your commission income drastically. We have partners that are single man, single woman broker shops that have been doing working capital for a number of years, where they have 70 to 80,000 of renewal income every single year that they can add, you know, just without lifting a finger. So a little bit more specific on some of the things we are doing, and some of these products are a little bit newer. In the first one I touched on a little bit, but reoccurring income. When a partner submits a deal to us and we subsequently fund that transaction, there's a number of different things that can happen. But one, working capital works like a credit line. It's not a take it or leave it, and then once you take it, and then you're done kind of transaction, and you have to wait until the term of that deal, which a lot of funding sources do. We view this as kind of a revolving line of credit, where if we approve a customer for 100,000 and they only want 25, that's fine. They could take the 25 and then come back at any point and take the remainder, and we'll write another note. When they do take the maximum amount, we would still try to refinance that customer at some point because we understand businesses constantly need access to capital and we want to be available for that. So at some point during the term, usually once they're 50% paid down, we'd also try to renew that customer and we would still pay the partner on that deal. But our sales team's engaging with that customer at that point. They're dringing up the transaction on your behalf. And all you have to do is sit back and at some point you get a funding notification that X amount of commissions are coming your way. It's the best call I can make all day. And extremely impactful to your business, given that you didn't have to lift a finger to do that. And then another new product that we have is called our choice product. And that's a little bit something you would get upfront as an offering, but especially with a lot of banks tightening up right now, Channel sat back and we looked at our entire credit spectrum of the deals that we booked. And there was a segment on top where the conversions weren't quite as strong. So what we did is we sat back and we said, what does that customer need to convert those deals? And especially right now with banks tightening up, and mind you, the largest funders of working capital in this space, if you're curious, they're all banks. And it's very similar working capital product to what we do. So a lot of the folks that are saying, oh, this is for people who can't afford it. Well, look who your competition is out there in the space for working capital. And our choice product was specifically designed to help folks like yourselves, help brokers swim upstream and start capturing some of that business. So it's hyper aggressive rates, it's longer terms, it's a monthly payment. It's hopefully everything you need to start capturing that better credit customer, especially as some of the banks are trying to shed some of that volume. This is a great product for you to step in and get a deal done and hopefully make them a long-term equipment customer as well. Another new product we have, this has been especially impactful. We call it our early savings program. When you think about working capital, it's structured much differently than an equipment finance transaction. The rates are going to be a little bit higher. The terms are going to be a little bit shorter, and you're not always getting a monthly payment. That's largely going to be dictated on our end by, do we think this is going to be disruptive to the business? Because if we do, would a weekly payment be better for them? If a monthly payment is going to be disruptive, we won't do it. We're not going to do it just to get the transaction done. At the end of the day, we want to see that 2.5 time metric we talked about where customers routinely come back to us. But at the end of the day, out of your big objections on working capital, one is term, one is rate, and one is your payment frequency. And when you specifically dive into rate, there's a number of, call it micro objections that come from rate. And a big one is people want this to look like their mortgage. They want it to feel like their auto. They don't want a prepayment penalty. They want it to feel like the consumer finance that they're used to. And as everybody else knows on this call, that's not necessarily the way the equipment finance space works, and it's certainly not how the working capital space works. So what we did is we came out with a product where we would waive all remaining interest in the deal at any point when the customer wants to pay off. So you would still sell your working capital deal like normal, but when you start getting those objections, hey, I don't want a prepayment penalty, I don't want to pay for more interest than what I'm responsible for at the time of payoff. When you start hearing those, now you have a place to pivot and offer them a solution.
Excellent. Thank you, Stephen. As you can tell, the channel team has been busy working on enhancing our existing offerings, but we're also keeping you, the equipment finance companies, in mind. Again, I had said earlier that we recognize the fact that most of the AACFB members are equipment finance companies, and you put food on your table by selling equipment finance deals. But we also hope that you hear us when we're saying that there are 56% of customers out there that are using working capital. And so we are proactively looking for ways to make it easier for you to have that conversation. So the last two things that are part of this slide are the quoting calculator. Within the past couple of weeks, we added an enhancement to our portal for our partners so that they can go in and input a FICO, a time in business, and some estimated annual revenues. And then what results is a range of potential offers that customer could receive. So it gives a dollar amount, they could be approved for this dollar amount range with this term and potentially this buy rate. And so that is designed again to help change the conversation and make, once you uncover a need, make it more actionable so that you have the opportunity to provide the borrower with some more insight on whether they may be interested in acting on it, and then allowing you the tools necessary to go ahead and close the deal. So we're excited about that quoting calculator as, again, a way to help our partners ease into more working capital activity. Final piece of the puzzle we had talked about as well was the bundled transactions. Again, providing proactive ways for you to change the conversation with your borrowers and insert working capital and just explore whether they've done it or not, and if they may have some growth projects or opportunities coming up where it might make sense for them to leverage that product. So Stephen, that is the information that we had ready to present. Monica, are there any questions that have come in?
Not yet, but as a reminder to everyone, if you have a question, please put that in the Q&A box right now, and we will get those questions answered. We'll give it just a minute. And again, if you would prefer to ask your question verbally, you can also click the raise your hand button, and we can unmute you to ask your question.
Stephen, while we're waiting, do you want to click ahead? I think Channel is offering something special to those folks that are on the webinar today. So as you can see, for those folks that attend today, Channel will be giving away one complimentary registration to the expo coming up in New Orleans in September. So Monica will provide a list of attendees to the Channel marketing team after the call. And for the lucky winner, we will be reaching out to you in the next day or two to get all of that registration information in your hands. So Good luck, everyone.
Yeah.
We do have some questions now. Do you work with sold props?
Yes, we do.
On both products, both equipment finance and working capital, absolutely.
Okay.
Matter of fact, if you got a business that was a sole prop is now, incorporated or whatever, we'd want to know about that. We'd consider that as part of their time in business, and we would include that as, so if you have a sole prop for 5 years and the LLC and it's showing 2 years time in business on their SOS, I would look at that as a 7-year time in business company, and they would be treated so respectively in credit.
How much do brokers typically make on a working capital cash advance?
On working capital, right now we're averaging, I think it's like 6.5 points. That's going to be largely dictated by transaction size. On the sub 50 stuff, you're going to see more of an 8 to 10 point range, and then anything in the 50 to 100K range, you're going to see a slight decrease, maybe a 6 to 8 points. And at the end of the day, on the, call it the 6-figure stuff, most borrowers aren't going to let you put 8 to 10 points in a deal. There may be an opportunity to do that. Stuff greater than 150,000, we cap people at 8 points. But I think you'd see more of an average of a 4 to 5 point spread there.
And Stephen, just to clarify, the partner or the broker has the opportunity to control the number of points, just like they would in an equipment deal. It's not
100%.
Channel would dictate. It's you reading the room and understanding your customer in order to finalize the pricing structure.
Right. So you might be willing to take a little bit less to get the deal done as opposed to pushing it and losing it. Yeah.
Exactly.
Do we need to get approval as brokers with you?
Yes.
What is that?
We would, so if especially right now, if we're going to consider working with someone, and we'd love to hear about, I can't see who's on the call, but I'd love to hear about each and everybody's business individually, and really just have more of a vetted conversation on what they do, how they think about the world, and give you a little more insight on who Channel is, and then mutually come to agreement on whether there's a spot to work with each other. the end of the day, we don't want to onboard someone and not be able to create any value. It wouldn't make sense for anybody for us to sit here and spin people's wheels. So yes, but we just want to have maybe a one-on-one conversation, or maybe if you're going to the upcoming conference, we'd love to connect with you and get a meeting going and learn about who you guys are and all that.
Okay. Is HVAC equipment okay?
Well, it depends. So we do look at soft costs like most funders do, and we typically cap at 20%. I think the issue we've run into with HVAC systems is they typically carry a lot of soft costs, and they're bolted into a building. So can we do them? Yes, but I would probably want to understand what's going on with that transaction. And I probably wouldn't want to do a one-off transaction for someone, even with an existing partner for an HVAC system. But if someone has a vendor that they routinely do business with, I would say, help me understand that business, and then we'll go find a solution, and then we'll just carve it out separately internally and find out a way to get those done. That comes down to kind of the understand and connect piece that we went over.
What's the average time for funding from application to, I guess,
we commit the decisions or some sort of response within 4 hours. A lot of the times, you start getting into month end and apps increase that may leak into 5-6 hours, but that would be the exception, not the rule. But I'd say most of the time you're getting a decision within, call it 2 to 4 hours.
And Stephen, are you talking about equipment finance for those timelines?
Equipment finance, working capital is generally a little bit quicker, right? The working capital goes quick, right? It's the opportunities comes across someone's desk. Alicia spoke to this earlier, but working capital is very much a right time, right place opportunity. Especially on your end, it can feel a little bit like of a war of attrition because you're advertising to people that don't necessarily have a need right now. But when the need does come up, it's usually I'm stretched out a receivable, I have a chance to purchase inventory, but that deal is there one day and it's gone the next day. So we understand we need to kind of align our speed with that type of business. And it is a little bit of miss by an inch, miss by a mile. So we tend to be very fast on the working capital side, to answer your question.
Okay. Next one, is this being recorded for replay? It is, and we will have it on the AACFB website, but also on the AACFB YouTube channel. They want to know if slides are available. So if you guys want to send me the slide deck, I can link that to the website as well. How to get in contact you to receive more broker information. Do you have a slide for that? There we go. Perfect. Are you doing corp only deals for equipment finance?
We are. What I'll say about that is we're going to be a little bit tighter on corp only transactions, and we'll never be the first person to do a corp only deal with a borrower. We'd likely want to see close to 100% comp credit on a corp only deal on a previous corp only transaction. And it's not that we can or can't do them. It just takes a lot longer. So that's just been our position for now.
Okay. Do you work with electric trucks? Would love to have a sidebar conversation with you about this emerging area. I think somebody on one of the other Meet the Funders was asking about electric vehicles, so that's a hot topic, I think.
We have no restrictions against electric vehicles. If someone's specifically teaming up and seeing a lot of that business, I'd say, yeah, we can do it, but I'd probably want to understand the vendor. I'd want to understand the origination model. And from there, I'd say, let's find a way to align our products that are meaningful for you. That isn't just a standard black and white credit box. So I'd say, yeah, there's no restrictions, no reason we can't do them. We've probably done a few already, just, with it being such an aggressive growing market, I'd really want to do it right. So I'd want to understand it first.
Do you have a formula for loan as a percentage of gross revenue?
Yes and no. So on working capital, we determine the loan size by how much revenues they're doing. We call it pull percentage. We're always going to take a percentage of their monthly revenues, annualize it out, and say that's how much we're going to give someone. But there's also a lot of different factors that go into that. For instance, I could look at a $10 million business, but if they only have $5,000 in the bank at any given time, I may even pass on that deal outright, regardless of the 10 million in revenues. But I look at a $1 million business that's carrying $100,000 revenues much differently. I'd rather loan against that business. But in general, and this moves a little bit based on credit profile, but I'm typically going to loan up to 10% of someone's annualized revenue. So that $1 million business, I'll probably loan 100,000. And again, that would cap out at 250. But if you're looking for a really easy rule of thumb, it's 10% of someone's annual revenues.
And that's working capital, Stephen?
That's working capital. Equipment finance, we don't, again, it's app only. So we're not really going to have that insight into someone's annualized revenues. Of course, if someone has strong bank statements and you have them, we'd love to see them. It can only help a deal. But we're not necessarily lending off someone's revenues. And I'll just caveat that if we do get banks and it's an equipment finance transaction, they have pristine credit, but if they're only generating 100 to 150,000 in revenues, you're probably not going to get a six-figure approval, right? We can't unsee what we see, and we will take that into account.
Okay. Are your working capital loans merchant cash advances or traditional term loans?
They're traditional term loans, but when I say that, we have two products. It's a loan, and then we also has a business advance, which is a purchase of someone's future receivables. Now, the term MCA or merchant cash advance is kind of a loose term that people threw around there, and it originally started as almost a credit card receivable things, but it really picked up in the retail space where people have daily transactions and they have a lot of them, and you're taking a percent of someone's daily revenues. That's not really how our product works. It is written more like a term loan, but some people out there may refer to it as a merchant cash advance. Personally, I wouldn't refer to our business as a merchant cash advance. It would be a term debt loan. Our average term is 13 months, where a lot of that credit card receivable stuff is going to run more on a 6 to 8 month term.
Do you work in all 50 states?
We do.
And then the next question I think you answered was average term loan. So I think you just answered that.
Yep, and that's on working capital. On equipment, it's going to be much more traditional, where if you submit a transaction, we're looking to give a 60-month approval every time, and unless more is needed on a special transaction or really hard collateral, and then less for older equipment, we would start to dial that back and try to align with how long we think the equipment's going to last.
Do you do yellow steel equipment and trucking equipment loans?
We do. Some of the newer yellow iron, as you know, is going to be a larger ticket size, especially the way inflation has ticked up the last 4 or 5 years. But we do, I'd say our bread and butter, or a lot of what we do, is used yellow iron. So dump trucks, skid steers, the whole 9 yards. So we do a ton of that. We do transportation. Right now, we're a little cautious in that industry, just like everyone else. We've seen an uptick in bad debt. So we are still funding in the transportation space. We recognize it's the backbone of the U.S. economy, but we are selective on what we're going to buy. And we're generally looking for the bigger, more established businesses with better credit profiles and larger fleets.
Are you doing corp-only deals for equipment finance?
We are. Just like earlier, we would not do so. Just because this question came up early, and just to clarify, we would never do a corp-only transaction on working capital. There always needs to be a personal guarantee. On equipment finance, we can do corp-only transactions, but I'll be the first to say it's not our bread and butter. It's not the best thing we do. We're not going to be the first ones to do a corp-only transaction, regardless of how strong the deal is. I'd want to see corp-only comp credit that has been around for 12 months and probably a matching dollar or larger dollar size.
Average interest rate structure, prime plus question mark?
So since prime's been floating all over the place and sounds like there's going to be a cut here in September, what I'll just say is, our rates on equipment finance range anywhere from right now, depending on whether it's a lease, we do have some FMB options, which can be a little more lucrative. Those are going to range from anywhere from 7.5 to 13.5. And then our bread and butter is really our EFA product. And that's going to range anywhere from 10 to 16% right now. In normal times, that might be more like 9.5 to 18%. But as Alicia said earlier, we're still funding, but we're trying to hit that $200 million mark, where previously it was much larger, but we've tightened up kind of our credit window to try to hit that 10 to 16% mark. I'd say we're averaging about 13.5, if that helps.
Is the loan termed out in full amortization, or is a revolving line of credit?
Working capital, I assume you're talking about?
Doesn't say, but I guess.
Okay, both. We view it like a line of credit, again, because anytime someone takes a note with us, we'll term that out. We'd layer in specific prepaid discounts. So if someone wanted to square up with us, we wouldn't necessarily look to penalize them. That's great. They could pay off the loan and they're available for the whole amount of funds all over again, just like they would on a line of credit. Or if they had multiple uses, if someone needed 25,000 this month, 25 the next month, and 25 3 months from now, we could do that as well. But we'd write each note on an individual schedule with its own amortization schedule. Each of those notes would subsequently have their individual prepays respectively. But we do that to allow for some flexibility where we say, don't take money that you don't need. There's too many funding sources out there that do that, especially in the working capital space where they force people into loans larger than they need. Our stance has always been only take you what you need and the rest is there as sleep good at night money.
And I think this is a clarification on the earlier one, but when you said you do trucking, you do over the road trucking as well?
Yes.
Okay. Where are you headquartered?
We are out of Minnetonka, Minnesota, about 20 miles outside the Twin Cities. Or excuse me, 20 minutes outside the Twin Cities.
Fun of our accents, just saying it could be a thing.
Are you currently taking on new brokers for equipment finance?
I'd say I'd love to have a discussion with someone. I will say if you've been in the industry for a year and you don't have prior experience, it's going to be a little bit tougher right now. I'd still love to have the conversation so we can get that ball rolling for when we're ready. We know who you are, and for working capital right now, it's a lot easier to engage with newer partners. On equipment finance, it's going to be a little bit harder to onboard right now. So either way, happy to have the conversation. And again, maybe that's something we start with working capital and roll up into equipment finance when we're ready.
I think this piggybacks on the other one. It says, is the interest rate fixed or adjustable using an index plus margin?
We don't have any adjustable rates like you would on a mortgage. Everything's fixed. But again, we kind of mitigate that with different prepay options.
Well, and Stephen too, I'll jump in and clarify, I started out by saying that Channel does risk-based pricing. And so it's not a approve or decline on a particular applicant. We look at them and then judge, the quality of the credit, and then we will price it accordingly. So it's going to vary on both products depending upon the quality of the credit.
All right. It looks like we've gotten through all the questions, which you guys are right, there were a lot.
That's good.
But that's great. That's great. Well, since we don't have any other questions that I'm seeing, we will go ahead and wrap things up. I want to say thanks again for all the participants, especially our valued funding source member and gold sponsor Channel. Thanks for a great job, Alicia and Stephen. We invite everyone to meet with Channel in person at the Commercial Financing Expo coming up this September in New Orleans. Thanks again, everybody, and have a great day.
Thanks, Monica.
Thank you, Monica. Thanks, everyone.